Morning and welcome to the Contact Energy annual results for FY22. Joining us today, we've got Mike Fuge, our CEO, and Dorian, our CFO. Hand over to you, Mike.
Okay, and kia ora tātou, welcome to the full year results presentation and a couple of announcements which we're very proud of as a company today. So without further ado, let's kick off. Go to the next slide. Sorry, that's me. The usual disclaimers and important information, which I presume everyone has read. If we acknowledge that and just move quickly to the way we're going to play it today, I'll go through the FY22 highlights, market update. Dorian will then kick in with a detailed review of the financial results. And that's not quite, both Dorian and I will do the strategy update, and then there's a fair chunk of supporting materials there, which we hope gives some colour and detail to the results we're announcing today. So look, another strong performance despite a volatile market conditions, and we are ramping up our investment. It was a year of two halves, I think, which a number of analysts have pointed out, from very, very good hydrology in the first half of the year to very dry and now back to very strong hydrology, all of which has led to another year of very solid results, which are close to the maximum that Contact has delivered without any new generation. They are volatile conditions, as you can see now in the market, but we continue to generate well, and gas field declines and high coal prices have obviously played into how the market has evolved. We've responded. Obviously, we have increased renewable generation output, and we continue to develop our thermal strategy. And we're down by about 16 million compared to FY22, but again, as I would emphasise, a very strong, robust result. We set this strategy out 18 months ago, and hopefully what you see today is us actually delivering on it in a very short space of time. Growing demand, growing renewable development, decarbonising our portfolio and creating those outstanding customer experiences, all of them underpinned by being true to our ESG commitments, the operational excellence which you see end to end across the business, and the generational arm right through to retail, and the transformed ways of working. Attracting talented New Zealanders to come and work for us is absolutely key to the go forward in this plan. 18 months, this is a bit of a scorecard. You'll see the green there and grow demand. Southern Green Hydrogen, the team have completed some great work, and we expect that to be finalised over the coming 12 months. We've had some very positive engagements with several parties about electrification. Lake Preem data centre is underway. Look, the lock-in major user electrification probably gone a bit slower than we thought, but we see what's on the plus side, there's been some great creativity. As Rio signalled a couple of weeks ago, those negotiations are underway, and there is goodwill on both sides. And look, we have supported around 50 megawatts of new to market lower South Island electricity demand. It's not just about Lake Preem, but there are other projects in there. Renewable development, Tahara is underway. It's over 50% complete. Te Huka 3, we've announced today. You've got to remember that project didn't exist 12 months ago. Very proud of what the team created. We'll talk a bit about that later, but it's got some very, very nice attributes. The solar partnership with BP Lightsource, the wind team with Roaring Forties, we've got a wind mast up. We're hoping for more. And we have completed the assessment of the grid scale battery. Obviously, lithium prices have put that on hold, but when it's right, we'll be able to build a battery. Decarbonising our portfolio, we announced the closure of Te Rapa in 2023, which will release around 200,000 tonnes of carbon per annum, and renewed our commitment to on TCC to 2024. We're on target to meet both our medium and long-term carbon reduction commitments, and I would call out that you remember this is a journey that we've been on for over a decade now, with the closure of New Plymouth, Otahu, Te Rapa. The reduction has been significant. Thermal review is ongoing, and the swaption that we announced with Meridian in many ways is a template for how the industry could organise itself for insurance products as we go through the decarbonisation transition. The outstanding customer experiences, look, we grew by 50,000 connections in the last 12 months, split roughly 50-50 between electricity and broadband, with the difference made up by gas. We launched that time of use offer with Good Nights, which we look to extend into an EV product offer. The wireless broadband, we've piloted, it's ready to go live in the next few months. And we're looking for a new brands and products. So obviously, we're very proud of what the team have achieved. They have won awards, they have grown market share, they have been innovative, and the broadband still remains an incredibly part of our proud recent history. Tauhara, look, it's not an easy environment out there, but the team aren't going to die wandering. They have responded to both the supply chain, the COVID issues, and unbelievable construction industry inflationary pressures. They've been agile, they've been creative. It remains an absolute cracking project. 168 megawatts, remember, that is equivalent to a wind farm 2.5 to 3 times that size in terms of output. Its plant capacity factor is second only to a nuclear power plant in many respects, and its carbon is remarkably low. That number there translates to 50 grams per kilowatt hour by manipulating around your exponential multipliers. And we've secured subsurface the production potential. In fact, the team have gone over and beyond, which forms the basis of the other announcement today for Te Huka, remembering that as part of the Tauhara field. So delighted about that. Demand, obviously, as we come out of COVID and with economic uncertainty, the closure of Marsden Point Refinery, North Skog, demand dropped slightly in the year, but we see reasonable green shoots in the medium to longer term around that. We are seeing with the, it's a wet year, as everyone knows, particularly up north, but we expect on average that demand growth to start growing in the future. Hydrology, bang on average for us, improved hydro inflows compared to FY21, and the storage is reasonably healthy. We're also seeing positive signs on Maui and Pohokura in terms of gas in the go forward, so a good result. Look, this graph we've been presenting for 3 years now about the various items which affect long-term electricity prices. There are some international effects, there are some local effects. Just wandering around the circle there, aluminium remains at very high. It's come off its peak a bit. Methanol prices remain high. Gas prices and carbon prices remain high. Demand is in line with expectation. Coal prices have gone through the roof with the Ukraine conflict, and hydrology is reasonably strong, all of which leads to the graph on the right, which shows an increase in sustained prices, which, quite frankly, and I think a number of analysts have pointed to, the price of firmed, reliable electricity is probably a bit higher than what people anticipated 3 or 4 years ago, as opposed to intermittent wind and solar. Retail competition, very proud of what the team has achieved here. It remains intense. We were delighted with the growth that the team were able to deliver. Obviously, it's not a market that's slow. There's a lot of dynamic in there. The acquisition by Mercury of Trustpower, it's an intensely competitive market. I think it's a market that we can all as Kiwis be proud of, particularly the turbulence you see going on overseas in Australia, in the UK and Europe at the moment. The competition is delivering for customers. Climate change and regulation. Look, I do want to talk a little bit about that because I think particularly in the turbulence we see overseas, we do see bipartisan support for the regulatory framework for the market we have, and the commitment to addressing climate change is bipartisan, which is great for this country. allows investment confidence in the road ahead. So you see the first emissions reduction plan, you see the very significant increases in the GIDI fund. In terms of renewable generation, the resourcing consenting reform, obviously climate change will be a key part of that, and the emissions trading scheme, which is under review, but there is a strong commitment as that being a key driver of decarbonisation in this country. There is a wholesale market review in the New Zealand battery project and transmission pricing methodology, which is now implemented. And it's worth just spending a little bit of time on that about how we are responding. So, look, wholesale market volatility, a couple of things in there. Prices have spiked very high in the ASX, if you look forward, is showing a significant increase. So we've responded. We've announced another 0.43 terawatt hours of investment today, which again is the equivalent to a 120 to 150 megawatt wind farm. We've announced our investment in wind and solar development, and we are very committed to responding to that call. The investment signals are there, and so responding to those is a key indication that the market is working. We've worked very hard with our customers. Look, given this volatility in prices, particularly large C&I customers, is moving into long-term PPA type contracts. I think that works for both parties. It works well. It enables us to commit to more renewable projects. It enables industry to have certainty around their input energy prices in the go forward, and to renew their commitment to help out on decarbonisation in the country. And obviously we continue our engagement with the EA. Climate change, we absolutely support the target of 50% total energy consumption being renewable by 2035. We will continue to develop and assess the opportunities in our pipeline for that. We continue to get alongside the government in this space. We work with others in the industry, obviously, for thought leadership around how we deal with the challenges in front of the industry at the moment, whether it's dry year risk, whether it's interseasonal variability, how we as an industry, while maintaining an intensely competitive market, which we have today, can actually find the right settings and investment and ensure that the right outcomes for consumers. And our carbon commitment, we have definitely covered our position there, and investment in drylands carbon has been a key part of that. The New Zealand battery project, look, it's not so much the solution as asking the right question. That is a question to be at, how do we cover intraseasonal and dry year risk? Onslow hogs a lot of the attention. I think there are other solutions out there that need equal consideration. And as I always have maintained, it's not going to be A, B or C, it's potentially D or all of the above. But all we ask for is that each option is assessed fairly and the market is allowed to throw up the innovation and most economically efficient solutions. And given the creativity of Kiwis, I have no doubt that this will be very much a feature of the go forward solution. And for the transition, look, whatever solution there is, it's going to take a wee while to come into place. It's important that there is an orderly transition, security of supply, reliable electricity supply, having electricity supply when the wind isn't blowing or the sun isn't shining is absolutely critical to ensure that we keep Kiwis engaged and enthusiastic about the transition. Energy hardship, we're playing our role here, obviously through IRANS. We've done that entity's done a lot of hard work. Typical, we don't see prepay as a product. We see it simply as a means of paying for the range of products and services we have. It may take us a little bit more effort and cost in terms of the way customers engage with us, but that is a key principle. And obviously the work with IRANS around energy poverty and making sure that we as an industry address that and address that well in the go forward is critically important. Right, Dorian.
Thank you, Mike, and hello everyone. So as usual, I just wanted to start off by talking about some of the key topics that came up in FY22. So the first is our mean hydro year EBITDAF has continued to progress upwards. A few years ago, we talked about it being $480 million. We guided to $520 million for FY22. We continue to see a sort of positive thematic going forward, market-linked channels from a price perspective. We think they're going to remain high, linked to the high and escalating thermal fuel and carbon costs, and the longer term channels, which like retail, which to date haven't really repriced. We're expecting more escalation in those going forward, linked to the increases that we're seeing around CPI. So all of that sort of comes together in a guided mean year EBITDA for FY23 of $550 million. Second point, which Mike sort of talked about a little bit, was we've seen the firmed long-run marginal cost of building renewables in New Zealand increase, and that's important because that sets the long-term electricity price. It's increased from historic levels of about $85 per megawatt hour to, we believe, somewhere now between $100 to $110 per megawatt hour, and that's a real number. And the reason why this is important, because it demonstrates there is some inflation protection in industry income streams. As inflation goes up, WACC goes up, long-run marginal costs go up, and electricity prices go up. Next topic, we're a capital-intensive industry, but no one actually reports return on invested capital apart from the major energy user group, and they've got a relatively unique way of defining it. So we're going to start reporting this now going forward. We think now is definitely the right time, because with us deploying a lot of growth capital into the markets, it's important that investors can see the returns that we're making on that. We're going to do it on a rolling 4-yearly average, because that irons out the annual volatility that you get in hydrology. Our starting position at the end of FY22 was 5.6%, which we do recognise is below our WACC, so there's an opportunity for us there to improve. But I can assure you that all the growth capital that we're deploying at the moment is going to deliver returns significantly higher than that. Mike talked a little bit about the demand environment. It's continuing to firm going forward. We've got that 50 megawatts of new market demand that we're seeing in the Lower South Island based on opportunities signed up. We've got the aluminium smelter, which is very profitable, and we're expecting that to continue into the longer term, because when you look at the supply and demand dynamics of aluminium, it favours the producers, in particular if you've got a green smelter like the one we've got in New Zealand. You've got hydrogen export opportunities that we're looking at, but some really interesting hydrogen domestic opportunities as well. And you've got the data centre opportunities coming through, and then the Giddy Fund, as Mike said, has been increased in size tenfold, so it's now over $600 million. Remember, that's the fund that's set up to support industries getting off fossil fuel onto renewable energy sources, and then actually, quite importantly for the dairy industry, it now covers the subsidy on grid connections, which we know has always been a bit of an issue for them around converting to electric boilers. We talked at the half year, we've sold half the volume of Tauhara, and we've sold it to counterparties with relatively strong balance sheets. And that's important, not just from a credit perspective, but these are players that could have contracted with independent power producers. We think it's good in terms of carbon emissions that they didn't, because obviously that's generally solar, which has got a very low capacity factor, which means thermal generation has to stay around for longer. Far better you contract with a new geothermal plant, which is at 95% capacity factor. And then the last point, which Mike actually mentioned, is around the Taupō announcement and the closure from the 1st of July 2023. So that takes 200,000 tonnes of carbon out of the atmosphere when it gets displaced by us building more geothermals. That's important that we continue to demonstrate that visible leadership across the industry around decarbonising not just our own portfolio, but the industry's portfolio. Remember, we're asking other industries to invest in their own decarbonisation, and consumers for things like EVs. So it's important that we are also decarbonising our own backyard as well. Taupō is actually a relatively efficient baseload thermal plant, so it does demonstrate what we've been saying for a while, is it's not economically viable to run baseload thermal generation anymore. In particular, if you take the market price of carbon natural gas and coal and put it through any model, you'll end up with a short run marginal cost, which is a lot higher than any of the netbacks you can get through selling electricity. On to the financial performance. So profit, $182 million, was down by $5 million. Within that, EBITDAF is down by $16 million, and I'll just sort of talk you through that. So our renewables were up by 111 gigs, and that allowed us to displace thermal generation and acquired generation and save $41 million of cost. And you can see the benefits of that coming through in our Scope 1 emissions. However, even though we had more renewable generation, we actually saw our sales volumes drop by 301 gigs, and that includes merchant length. And that reflects the fact that our thermal generation was down by 547 gigs, which was actually more than our renewables was up. So the reason for that is we acquired less gas year on year, about 4.5 PJs less gas, and we were only comfortable taking our gas storage down to 4.7 PJs because we always want to retain some residual gas there for future fuel risk. The other topic is with the wholesale pricing dropping year on year because of better hydrology nationally in FY22 relative to FY21, less opportunities to get merchant length by acquiring generation like the swaption. So that also impacted our sales volumes. So that was a $6 million impact. With Contact being sort of 80% renewable, you'd expect us always to be in a situation where the cost inflation on our thermal assets and acquired generation is higher than our price, is lower than our price increases. Unfortunately, this wasn't the case in FY22. We had an unusual situation that in FY21 we had good hydro inflows in autumn going into winter, and at times when other people's catchments were relatively dry. So we got some very good length at some very good pricing, which hasn't obviously repeated, and there's about a $24 million headwind associated with that. We've also got the full year impact of the transitional TY contract flowing through, and we'll talk about it in a bit, but we had relatively modest increases in terms of prices with our retail business, and that reflects, the focus on the consumer and also, regulatory risks associated with that channel. So overall, that left us in a position where our pricing was actually down by $10 million, even though we saw $26 million of cost inflation on acquired generation and thermal fuel. Location losses were up by $9 million. That was a function of more South Island generation up with the hydro, but also less North Island generation with less thermal and acquired generation. And then other income and expenses and fixed costs were up by $6 million. So that's the EBITDAF. In terms of the back to net profit, depreciation was higher by $13 million. As we're going through our S4HANA project, we're identifying components of the legacy SAP system that won't be needed in the new one and accelerating the depreciation on that. But going the other way, we had interest costs were $14 million lower. So our underlying interest is lower year on year because we've got the full year benefit of that equity raise that we did in February 2021 flowing through, so that's worth $3 million, but then you've got $11 million more capitalised interest associated with Tauhara as that project gets closer to completion. So we had capital work in progress on average for FY22 with about $200 million higher than FY21 for that particular project. Tax expense is lower, by $3 million linked to the lower profits, and then we've had a favourable movement of $7 million on our fair value of financial instruments. And for the technical people out there, that's because we've had a big increase in interest rates that everyone will be familiar with and the impact that has on our interest rate swaps. But in terms of the performance across our three segments, the wholesale business up by $21 million from an EBITDA perspective, but retail was down by $39 million, and that reflects, we have an arm's length market driven transfer price into the retail business, but as I said earlier, it hasn't been able to recover that from customers, and that's not a Contact topic. I mean, that's the same across the industry, I'd expect. And then corporate costs are down by a couple of $1 million year on year. So we now get into the wholesale business. So generation costs are down by $42 million year on year. That's a function of the higher renewables, but also, like I mentioned, that having access to less natural gas. So that meant our thermal generation was down by 33% and our acquired generation was down by 30%. We are getting a lot of cost inflation coming through here, though, and we expect that to continue into the future with higher thermal fuel and carbon costs. So 14% increase in the marginal cost of running our thermal generation, which is up at $109 a megawatt hour now. and then a 22% increase in our required generation costs, which is up at $142 per megawatt hour now, with that sort of indexing to what's going on for international coal prices, which Mike mentioned earlier. The other topic to call out is our gas and electricity transmission costs dropped by $6 million year on year. There was more constraints on the grid in FY22 than there was in FY21, so our transmission rental rebate was $3 million higher. And if you also remember, we contributed $2 million to Transpower in FY21 to get them to hurry up and start the Lower South Island transmission upgrade. That's obviously non-recurring. And just to add that, I mean, that was a fantastic investment for us, because we're already seeing the benefits of that with the downpours of water that we've seen in the last month or so, with prices in the Lower South Island connected to prices in the rest of the South Island, and the ability to export more water. And obviously it's good from a TY mitigation perspective, because now our exposure to a TY exit isn't just our South Island, Lower South Island generation market share, it's the South Island market share, which is a lot lower. So in terms of generation, geothermal, very good performance, 3.3 terawatt hours, all the assets performing very well. Hydro, a mean year, it makes it sound quite simple, 3.9, but as Mike said, very volatile. We had a huge swing between halves, 850 gigs less water in the second half than in the first half. And because the replacement fuel costs keep escalating each year, that volatility costs more and more money. So that's worth about $100 million if you price that on a fuel replacement basis. Also linked to the lower hydrology in the second half of the year, unfortunately, we had some challenges with our thermal assets. So we were actually without both peakers from March through to May. And we've got a crack on the radix of TCC, which is limiting the operating hours that we can use that for. And so in order to conserve hours for the winter, we actually took TCC out of action in April as well. So that actually meant April we had no thermal assets available apart from Whanganui, which, as you'd expect, coincided with a very low EBITDAF that month, although we were 100% renewable. And just on the assets, TCC we're expecting to have available for the winter, and then we'll take it down, repair the radix. We're expecting the second peak to be back in September. And I would say about TCC is, you know, once the radix fixed, the condition of the asset is very good. We've got the contracted gas, and the market conditions going forward around the ASX are conducive to us keeping TCC up and running till September 2024, and we don't expect any capex to enable that. And that's obviously good from an industry perspective, because it continues to displace coal. In terms of wholesale contracted revenue, I just wanted to talk a little bit about the market. When you look at what analysts are predicting in terms of industry EBITDAF growth, like for like, I think it's up about $150 million. And you can get to that number. There was some big one-timers, adverse one-timers in the prior year result. I'm thinking about Genesis dispute on carbon with Beach, and then Mercury had the issue with Carwell, writing off that out the money position with Norski Skew. That's worth about $60 million, I reckon. And then in terms of fuel, lower fuel costs in FY22, you've got 1.4 terawatt hours more hydro, and you've also got Taratea coming to market as well. So you've got about $140 million in lower fuel costs. So it's about $200 million increase in EBITDAF for that. And then going the other way, you've got the full year impact of the transitional TY deal, which takes you down to 150. So you noticed I didn't mention anything about channel pricing in that, and it basically means that any price increases that the industry have got have just offset cost inflation. And then with most of the cost inflation being linked to thermal assets, which only make up 20% of the generation, you're probably scratching your heads going, how can that be? And that does highlight the issue, is that there's about 60% of volume isn't repricing. It's either TY or it's mass market. So I'll get to that point in a bit. If you look at Contact and the channels are repricing, CNI is up at 115, and our CFDs now are up at 139. Our strategic fixed price channel, which is TY, and it also includes all our long-term contracts that we've signed that have got inflation protection. That's all a price reduction, but that's linked to the transitional TY deal. And then if you look at the transfer price into the retail business, remember that's arm's length market driven, up by $13 a megawatt hour, but you'll see in the retail side, issue is that's not being recovered from the market. So I made that point right at the start, not to sort of downplay the sector, but it does highlight the opportunity around repricing of TY. but it also highlights that, you know, our mass market channel for us is the lowest netback of all of our channels, with the exception of TY. In terms of our wholesale trading and merchant revenue, big drop here of $87 million. This reflects what I talked about earlier. We're able to get length in FY21 into some very good pricing because we had favourable hydrology when others didn't, and you can see the impact of that in terms of a falling wholesale price that we're getting there on our length. And also, just with wholesale prices dropping on length, less opportunity to, you know, run thermal kit and acquire generation, and therefore our merchant length went down from a volume perspective too. In terms of location losses, already talked about those. Those were up by $9 million year on year. In terms of our retail business, I said at the half year, you know, there've been some quite big changes with the external environment. I'm thinking TY staying beyond 2024, which we have always been pretty positive about, and TY are now positive about as well, based on their announcements. We've seen some significant increases in inflation. So we were going to look at the settings regarding retailing of electricity, and before we get into the performance, just want to give you three sort of conclusions on that. So with retail netbacks now so heavily discounted from other channels, we don't see value in increasing our retail load from where it is at the moment. However, we do see value in continuing to bundle and non-energy products with our existing customer base, and leveraging fixed costs and building on the success that we've had around broadband. Also, with price changes for this channel more linked to CPI, because it is a consumer-facing channel and a longer-term channel in our view, we do see more price escalation going forward linked to the higher levels of CPI, which we think will start balancing this channel back to others and closing the gap. In terms of the overall performance, though, you can see that disconnect between the market and consumer prices coming through in the retail electricity gross margin, which is down by $43 million. With tariffs only up by $5 or 2%, but we saw earlier that the transfer price into this business was up by $13 per megawatt hour. We have been very successful around connection growth, and we've got consumers telling us they really want to decarbonise, but they don't have the tools, and the Good Nights product that Mike mentioned is exactly the type of tool they're after. It incentivises them to shift their load off peak from peak times to off peak, which decarbonises the overall electricity portfolio. So that's fantastic. Connections were up 25,000 as a result of that. If you look at gas, gas margins are down by $5 million. Whilst we put tariffs up a lot, there's 3 levels of inflation coming through now. Comcom has signed off an accelerated capital recovery for the gas infrastructure owners, so we're seeing 13% increases in gas transmission on a like-for-like volume basis this year, and then it's going to continue to go up 10% every year thereafter. So that has to be recovered. You've also got higher carbon costs coming through, and you've got the higher fuel costs coming through. So unfortunately, remember, this is a traded product for us. We'll need to continue to look at our tariffs to recover those 3 lots of escalations that are coming through. Broadband's performing really well, $7 million of EBITDAF, and even when you overlay the OPEX associated with that, that's still $5 million of EBITDAF, $7 million of gross margin. In terms of cost to serve for this business, continues to perform very well, down by $1 million year on year, even though we have 51,000 more connections. And that talks to all the work that's happening around digitalisation. We've actually got to the point now where our call centre staffs can actually handle twice the number of connections that they could in the previous year, which obviously all flows through as productivity, which is fantastic. In terms of greenhouse gas reporting, as I said earlier, as you'd expect, that's down. Scope 1 emissions are down by 258,000 tonnes, linked to the increased renewables. And Scope 3 emissions are down due to the lower use of the swaption. We do report the swaption as a Scope 3 emission, even though it is a financial product. I think I said this last time. If we didn't call it, Genesis wouldn't run the ranking and the emissions wouldn't go into the atmosphere. So that's just us being genuine. Within Scope 3, though, we see within that you see a little tick up, and that relates to the construction associated with Tauhara. Sustainable construction is something we take very seriously, and in particular with the increased renewable development we're doing, we're looking at opportunities around that. In terms of our OPEX, I think we said previously that we'd taken $13 million of metering costs out of OPEX and disclosed that as gross margin. And that's to align us better with what others within the industry are doing. We've restated the prior year to be aligned to that. OPEX is up by $12 million, 6%. And the slide sort of explains the key movement. We've got a bit of full year impact of our acquisitions that we've done flowing through there. There were some one-timers, a number of one-timers in the prior year and this year, which sort of nets to $1 million increase. We're seeing bonus costs for staff lower because we had a very strong performance in FY21. And then you get to the underlying performance where the OPEX is up by $5 million, which is 2.5%. I'm actually quite happy with that because you've got some quite high underlying inflation within that. Insurance is 7%, sort of underlying general inflation is about 6%. And we've invested $3 million more in our brand. And we've been able to keep a cap on OPEX because of the productivity, not just the digitalization, but the good work the procurement team are doing around where we're rolling over contracts with suppliers, making sure the escalation in those is well below beneath the level of underlying inflation. And then we've got more OPEX being invested in growth. So this is the money that's going towards the Southern Green Hydrogen project, building our wind portfolio and the additional connections we have within our retail business. Just coming back to that brand, we don't take investing a further $3 million in our brand and advertising lightly. We're actually quite proud that we've underinvested in it relative to others within the marketplace historically because it allows us to offer more competitive pricing. But with the value of the brand sort of transcending both the upstream part of the business and the downstream part of the business, and our strategy around leading the decarbonisation of New Zealand and building a lot more renewables, we do think now is the right time to have a strong brand within the marketplace. Our cash flow, so remember at Contact we talk a lot about cash conversion, which is what percentage of our EBITDA actually converts into operating free cash flow. Remember, it was quite low at the half year of 41%, but we did predict that it would improve and get to 60% by the end of the year, which is exactly where it's ended. It's still slightly lower than the 67% we achieved in the prior year. And just some of the reasons for that, we've seen a $17 million investment in trade working capital, which is obviously negative from a cash flow perspective. There's a few topics driving that, but one in particular, the staff bonus accrual was lower at the end of FY22 than it was at the end of FY21. Obviously, the bonus costs are lower for the reasons I've already mentioned, but we've also shifted our remuneration structure. So anyone below senior manager has now had all of their at-risk short-term pay bought out and gets paid out in their a monthly salary, which is obviously negative from a cash flow perspective. We're seeing CapEx higher at $75 million, but this has been guided. This is the sort of $100 million of additional stay in business CapEx that we talked about spending cumulatively over the next 4 years to support S/4HANA and some projects which increase the resilience of our renewable assets and get a few extra gigawatt hours out in terms of the Roxburgh runners. And that's important to do that at a time when prices are relatively high. So all of that gives an operating free cash flow of 41.8 cents per share, dividend 35 cents a share. So there's some retention there which go towards building high quality renewable development. And then you can see in the top right our new KPI, return on invested capital. In the appendices, there's a lot of workings to actually explain exactly how that's created. But you can see it's on an upward trajectory up to 5.6%. One of the reasons why it is a little bit depressed at the moment is aligned to our Contact 26 strategy. We are accelerating the depreciation on a number of assets based on where we see the asset portfolio being in a number of years' time. In terms of balance sheet and interest, so the half year our interest expense was relatively high at 5.7%. It's dropped back down to 5.3%, and that reflects us better adjusting for the money from the equity raise. So we've got the percentage of variable interest back up to 29% now. And remember, the variable tends to be cheaper for us than fixed. However, year on year interest have stayed roughly the same. It's up from 5.2 to 5.3%. And whilst we've now got a bigger percentage of variable interest, we've seen obviously variable rates go up quite considerably. On average in FY21, they were 30 basis points. On average for us in FY22, they were 152 basis points. And by the time you got to the end of the financial year, they were up at 300 basis points. But I think everyone here is familiar with the rapid rise in interest rates. In terms of balance sheet capacity, our net debt to EBITDA is at 1.5. So relative to our sort of 3 ceiling that we've got linked to our S&P credit rating, we've got $825 million of capacity there. So that will support us with our Te Huka 3 project, plus other projects that we're looking to do. And we've got about $390 million of go forward spend on Tauhara as at the end of FY22 as well. If we do need more capital for whatever reason, we've got about $400 million of capital bonds that we could do and get the $200 million equity credit on it. We're going to continue with our undiscounted dividend DRP, but we could shift that to a discounted one and get a higher take up, which others in the industry have already done. In terms of the dividend, we guided that the dividend for FY22 was going to be 35 cents per share, which is exactly where it's going to be. So we're announcing a 21 cent per share dividend, final dividend, 90% imputed. That takes the overall dividend paid and declared for FY22 to 84% of the operating free cash flow, the average of the previous 4 years. So within our guided range of 80 to 100%. We are continuing with our undiscounted DRP for shareholders as well. And we're guiding to a dividend for FY23 of 35 cents as well, keeping it same level as FY22. That does reflect we're still in a build phase. And it also reflects obviously that there hasn't been an agreed new long-term contract put in place with Tiwai yet. And then this is just a bit more workings around our mean hydro year EBITDA of $550 million. Just to highlight a couple of things. So pricing's going up linked to repricing of CNI, but also mass market going up linked to higher CPI levels. We've got some quite big increases around transmission and storage linked to inflation and a number of regulatory changes feeding into there, like TPM, like the accelerated recovery of gas transmission for the capital recovery for the owners. ACOT's no longer available, all those types of things. And OPEX is higher as well year on year, reflecting inflation. We've got 5% wage and salary inflation feeding through here. We've got some more money on growth and ESG type topics. And we have got some one-timers. Unfortunately, we had a big favourable one-timer in terms of the Holiday Act provision release. And then we've got some one-time costs in FY23 as well. So there's quite a big swing associated with that. But then this provides all the detail which you can use for your models. In terms of the risks for that, obviously hydrology is a risk. We have been relatively modest about the amount of gas that we're assuming that we will consume with our thermal assets. But if we get more gas available and the market pricing is conducive, we can obviously run our thermal assets harder and make a bit more money through those. And in terms of market price risk, you can see from the donut charts, we're relatively well contracted. There's about 40% of CFDs and 30% of CNI volume that isn't contracted yet.
Right, and I'll just return you to the strategy and we'll talk a little bit about the Te Huka investment. Just mindful that this project, as I said, didn't exist a year ago. We thought we were going to do Tauhara and then get on with GF Futures, which is next down the track in terms of the Wairaki replacement. But the team, the subsurface and the drilling campaign that we did for Tauhara has been remarkably successful. And you see right on the bottom right there, we've already secured the resource in terms of wells drilled, which is a great outcome. There was grid capacity and there was consent available. So what that added up to was an opportunity to put in what is effectively the equivalent of a 150 megawatt wind farm slotted into the development pipeline. It fits very neatly between the Tauhara project and the GF Futures, or effectively Wairaki replacement in terms of resource utilisation. The construction costs, look, it's fair to say that the whole industry is experiencing construction cost inflation. Our market intelligence out of Australia is that they're seeing pressure on wind farm developments and solar developments in the order of 30% from what the numbers that people were experiencing 2, 3, 4 years ago. and the cost is in line when you take account of the inflators from roughly in line with what we put into market around 2017, 2018. So we are confident in the number. It does allow us to take advantage of both of the retirement of Te Rapa, but also the fact that at the moment you see firmed prices for reliable firmed electricity in the go forward ASX. And so the simple answer is get on with it. And I do want to pay credit to the team who pulled it together in such a short space of time. We have been conservative on the estimate. We have a good EPC contract in place underpinning it, and the balance of plant, we have got market bids in for those. So we're confident of that cost, much more confident in that cost estimate and the go forward. It reflects the market conditions we see today. And the added bonus there is we have the resources currently working on Tauhara. They'll swing across. We very much expect them to swing across and work on this project. If we go to the next slide, this is, we've obviously got Tauhara there, and with the capacity upgrade that we announced in February, you've got the Te Huka, which we're taking FID on today, and then with the GeoFutures project, just through increased efficiency of new plant, we expect another 0.4 terawatt hours there. Behind that, there is still around 0.7, 0.8 of consented offtake for Tauhara, which would eventually lead to another plant appropriately placed and sized on the field, which leads to, for the geothermal business alone, an almost doubling in output over the next 5-6 years. And for our overall renewable pipeline, if you remember, mean hydrology year, we put out about 3.9 terawatt hours of hydro, takes us very close to that 9 to 10 terawatt hours of renewable generation output from the company. You can see on the right there, the timeline as we see it playing out. You see the announcement today, the commitment on Te Huka, which goes with the commitment and the capacity increases we've previously announced on Tauhara. And we look forward over the coming years to the maturation of the GeoFutures project, announcements around that second half calendar 23. Go to the next slide. Dorian, you can talk to this slide.
Yes, and this is obviously the money slide. With Tauhara and Te Huka, we are spending a significant amount of capital, so $1.1 billion that we're deploying to increasing renewable development. That is going to increase our Contact renewable generation by 25%. So that's a pretty significant number. It brings 1.825 terawatt hours of energy per year to the market. So what we want to do is sort of give a little bit of guidance as to where that's going to take our EBITDAF. So we've already talked about our mean year hydro EBITDAF for FY23 being $550 million. So of that new energy that's coming to market, 875 gigs of it will just be a fuel replacement. So it will displace Te Rapa and TCC. So that just naturally happens. 700 gigs of it will just service the PPAs, the long-term PPAs we signed up with Fuge and Genesis, which will just happen. Remember, they've got inflation built into them as well. And then you've got a smaller amount, 250 gigs, which is a merchant strip, and we've shown it there linked to the pricing in calendar year 2025 when it comes to market. You look at those things and you go, well, assuming we execute, which we're passionate that we will do, then the only real risk there is around the 250 that's got a merchant strip price linked to it. You then got a bit of extra fixed cost, and that reflects that the fixed cost for Tauhara and Te Huka 3 are slightly higher than the TCC costs and the Te Rapa costs that are coming out. And that some of that is because we've got the carbon costs for geothermal in there as well. So overall, that leaves us with, for calendar year 2025, $720 million. Remember, the other thing we haven't done there is we haven't shown any repricing of our channels. We're just keeping that at the FY23 level. We'd expect channels to obviously reprice between 2023 and 2025, in particular retail. And then the other positive thing about this, you look at the scope 1 and 2 carbon emissions, they dropped from 787,000 tonnes down to just 350, which gets us well on the way to our targets that we've set ourselves. And I think Mike said right at the beginning, this is also great for regulatory risk for the industry. Prices have been high now for a while. That is telling us we need to build more generation, more renewable generation, and this is the first, I guess, a serious announcement that's happened since Harapaki back in February 2021. Remember, this project will happen. It will be online in the next couple of years. We don't have to worry about EPCs or financing. This will get built.
And so, look, the theme of today is very much about execution and delivery, as well as commitment and promises. And so I did want to finish saying, you've seen what we've done in the last 12 months, and I think you'll agree we've been pretty busy, and those key pillars of the strategy we've actually executed on very substantial decisions in that, which is very much capped off by what you see today. And so what do you expect in the coming months and year ahead? Well, you'll see a decision on hydrogen, both export and domestic. You will see the commitment on data centres in the industry, and you'll see some pretty chunky announcements around boiler electrification. Somehow we've got Western Energy up in demand growth. It probably belongs with renewable, but we're delighted with the acquisition in Western. And what you're going to see over the coming 12 months, the board have already committed to investment in a new core tubing unit drilling, which allows us to relife some of the 300 penetrations we already have in the Wairākei, Ohaki and Tauhara fields. And we see that as a real opportunity for taking down the cost of reservoir management and the drilling campaigns. In terms of the renewable, continued progress on Tauhara. You'll see Te Huka 3 well underway. You'll see the consents for the Wairākei replacement project. You'll see us get underway on solar and wind consenting, some announcements on that. You'll see progress on the Roxburgh runner replacement, and you'll see us relifing the transformers of our critical Roxburgh and Clyde hydro schemes. In terms of decarbonisation, you'll see continued progress on the thermal review that we're undertaking. We continue to develop the thinking around that. We'll be preparing for the end of the current allowance we have around TCC life, and you will see the actual closure of Te Rapa and handing the boiler over to Fonterra. And in terms of the outstanding customer experiences, we've talked to the success we've had to date in the last year, and again, I do pay tribute to the team because they've done a remarkable job in turning around a decade of otherwise decline in that business. You will see the launch of an EV product, you'll see the launch of additional products, and you'll see hopefully not continued growth in just straight out connections, but continued growth in the high value that we can bring to ordinary Kiwi homes in terms of multi-products, enabling ordinary Kiwi homes to decarbonise their business. And so we started with that decarbonisation journey at the very beginning of this presentation at a macro level, and we're finishing that journey today in this presentation in every Kiwi's home. And with that, we're happy to take questions.
Thank you, Mike. On the line, we'll go to the line first for questions. And the first question comes from Grant Swanepoel from Jarden. Grant, unmute yourself, *6, please.
Good morning, team. First of all, thanks so much for the calendar 25 720 expectation, helps us. Just thinking about Gentel as being a defence against inflation, with your dividend remaining at 35 cents, can you put some colour around calendar 25 and beyond on where you think the dividend can get to, and that your free cash flow per share could potentially rise from 42 cents to 58, 60 cents? And with an 80 to 90% payout, that's somewhere between 46 and 52 cent dividend. Does that make sense? And then should we be helping investors to think about that?
Absolutely. Dorian?
Yeah, I mean, we can't obviously go into specific numbers, Grant, because we don't normally guide out that far. But The intention is, as we've said all along, as we have increased EBITDA and operating free cash flows due to projects coming online, we increase the dividend accordingly. Obviously, we've got Tauhara coming online first towards the end of 2023. So that should be positive from a dividend perspective. The other topic is we are pretty low in the range, which we've said reflects the fact that there's not a long-term TY contract in place. So that's the other determinant of what happens with the dividend. I think it's fair to say, the board will be more comfortable holding a dividend level that's more within the middle of the range once a long-term deal on the TY contract has been done as well. So I hope that helps, but I can't give any sort of specifics around the numbers that you sort of talk to, because obviously we don't do that type of guidance.
Fantastic. Thanks. Can I go on to my next question?
Yeah, sure.
It's around Te Huka. So this 20% cost increase relative to Tauhara, it's not, are geothermal getting the same sort of cost pressures from the Ukrainian war that wind is getting? I wouldn't have thought so. And then can you link that into your long run marginal cost expectations? In that 100 to 110, does that mean that you expect wind post this Ukrainian crisis to start jumping in terms of where those long run marginal costs were landing? And finally, on the Te Huka side, you had indicated that you probably weren't going to pull Te Huka until you had a PPA against it. How are you developing on those DC PPAs that you were talking about in the past?
Yeah, so let's just unpack that a little bit. So yes, the cost, we've been very conservative on the cost estimate for Te Huka. It reflects in part we don't get the scale that we've certainly got on the Tauhara plant. Remember, Tauhara is over 3 times the size of Te Huka. And it had an EPC, it's got an EPC contract in there that was effectively done in completely different economic conditions. We are seeing, and we were somewhat surprised by the market intelligence coming out of Australia, that wind projects there are already seeing those cost pressures, particularly coming out of steel at around 30%.
Yep.
And that was reasonably recent. And you're right, we're not as exposed to that because the subsurface is effectively for Te Huka is locked in, it's drilled, the steamer's behind the wellhead and ready to go. There is some exposure there. For those who visited the site last year, we hope to get you back next year. There's a lot of steel and concrete, both of which have experienced those cost escalations, but I think you're right, we're not as exposed as wind and solar.
Just on, I mean, we were very mindful of the increase in capex on a dollar per megawatt basis, and we could have waited with this project and done it, done it 6 months later, and that would have led to a lower dollar per megawatt. However, we do have to work through how this fits with our GeoFutures project around, replacing Wairaki. And if we delayed it, it would start to impact the schedule around that. So the timing was useful around integrating with that project. But the other point is the market that these electrons are coming into, with the pricing being relatively high at the moment. It's gonna, you can do the maths. I mean, it's going to throw off about $60 million of EBITDA in the first year. So every month you delay it, sort of dwarfs the higher capital costs that you're going to have through announcing it at the current moment in time. So as Mike said, I mean, we've been impacted by global commodity prices. One of the bigger impacts, though, is New Zealand prices in terms of construction costs and sourcing finished goods in New Zealand. Although commodity prices have come back down again, they're still quite a bit higher than they were. But finished goods that you purchase in New Zealand haven't actually started to really come back down again yet. They sort of lag commodity prices. So again, we are being impacted by that, by the timing of the project, but we'd expect that to drop for future projects. And as Mike says, this is a relatively small project for us. So all the pre-FID work that you do around, design, consenting, development is relatively is a similar amount of money regardless of the size of the project, and this is only a 51.4 megawatt project as opposed to 170 megawatt projects like some of the other ones that we are doing and are talking about doing. So that's all flowing through. We do expect future projects to be lower. I think we're sort of talking about 5.2 to 5.5, reflecting a continued drop in commodity prices and starting to see some of the finished goods costs in New Zealand flowing through. But we do think it's going to, the cost structure of geothermal and building is a bit different from wind and solar, and we analyse that quite a bit. But we do see all forms of generation being sort of relatively impacted in the same way by what's going on internationally. I think it flows through in different areas, but we see it leading to roughly the same answers.
Last part of his question, Grant, you asked about PPAs, and I think the approach to this is that this project is incredibly economic with its merchant exposure. And where we're going with PPAs is we take them at a portfolio level, and obviously, with TY and the ongoing discussions with Rio, once we get that landed, then that sort of will set the tone for how much of the portfolio that in the go forward we contract, and remembering that portfolio is going to grow significantly over the next 4 to 5 years.
And on the long run marginal cost expectation?
Well, that's what our firmed long run marginal cost expectation is $100 to $110 per megawatt hour, Grant, and that's real.
Oh, thanks.
Okay.
My last more technical question, just on your strategic fixed prices jumping by 450 gigawatt hours based on the start of last year. Is this taking into account half of the CFD with MEL and the swaption? And can you give us a bit more colour on the CFD and the swaption pricing?
I don't know.
Oh, the Meridian swaption and CFD deal.
The strategic fixed price sales, I guess that's probably a new classification, Grant. I don't think it's jumping that much. It'll just be a full year of our sort of TY.
I think the pricing should be dropping year on year, and it's the full year impact of the transitional TY deal, Grant.
Okay.
Yeah,
Thanks, guys.
Those forward CFDs aren't in there, Grant.
Yeah, they aren't in there.
Thank you.
Okay.
Thank you, Grant. We'll go to the room now for any questions. Andrew?
Questions. Thanks. Follow on actually, first of all, just around Te Hoka and OPEX is 20 versus the 15 for Taupō. Can you sort of talk through that? Is that all economies of scale, or is it not?
Oh no, it's a different type of plant. Obviously, it's a different type of plant. There's probably, we used to call them the oil and gas. The Lund scale is a bit more complex, and there is the economy of scale. So that's probably where your expectation is.
Yeah. And then I guess I have a few questions just around volatility and getting a sense of have a normalised hydro number of 550, which is great. I guess the question I've got is, even going back to when you had the 480, do you think the earnings volatility has increased so that the potential upside, potential downside range is greater than it was? And can you sort of talk to that?
The volatility increased, but I don't think the earnings range has. I think what you've seen is a shift. Dorian, you might want to elaborate.
Yeah, I mean it's how it's sort of what's the normalised curve look like, because we have reduced our fixed price load as well, which reduces downside risk but provides more upside opportunities as well. I think the point around the volatility, and this point I made in the when I was talking about it, is because the fuel replacement costs are escalating so much at the moment, that means volatility costs you a lot more money.
Yeah.
And that's the same across the industry. But I think we've benefited from the fact that we have reduced our fixed price variable volume load regarding that.
Yeah.
And obviously we've got access to a range of mitigations which support us as well.
But yeah, Andrew, that we're endeavouring to aim within the same earnings at risk amount on an absolute basis, because we believe we've set that at the right risk return trade-off. We've got some of our mitigations falling off, including swaption at the end of the year. So we continue to reduce our fixed price sales position, but yes, earnings will be more volatile, but not to the downside.
And the other thing is our operating free cash flow is relatively stable as well, because in times when there is a lot of water, we tend to inject more gas, and when there isn't, we're using the gas. That sort of evens out the volatility from a cash flow perspective as well.
Yeah, sure. And then just in terms of swaption, a couple of quick queries from me, I guess, on that one. In terms of the swaption piece, you're able to tell us what the megawatt capacity you've got here to Mercury? I think you've got the one.
Yeah, 50 megawatts for the swaptions.
And in terms of the CFD, is that just through the winter months as well? So
I think it's 8 months actually. The CFD, March to October.
And last question I just had was just around the batteries. So you've done all the work on that side of the economic. I guess interested to understand how far away you are at the moment. And I guess the other piece is just given, I guess, just in the short-term volatility we're seeing, I guess the revenue piece on the battery economics has been improving, but clearly offset.
Yeah, I mean, the increase in lithium prices has been eye-watering. And that even with the increase, so you're right, the intraday spread is what drives the economics of the battery, and the increased volatility is only good news for battery economics, but the increase we've seen in lithium prices just have completely outweighed that. And so we've done a bit of work in the background. We're still progressing resource consent and looking at sites. So the intent is that when the time is right, we are indeed ready to go. But you're right, those two, both the supply side and demand side, are two very important components of that.
The other thing is to remember also that when the battery was sort of ideated, it was also talked about as being a mitigation to a certain extent to a TY exit, because it allows you to run an extra 100 megawatts over the HVDC, and obviously that the value of that mitigation is diminishing quite rapidly at the moment based on TY's keenness to stay.
Be able to give us a sense of how much battery costs need.
Well, when we started the assessment, and when we ended the assessment or stopped counting the assessment, capital costs up by about 50%.
Yeah.
So,
20% full.
And I don't think you can get an EPC on building the battery either anymore.
Well, the major suppliers aren't even offering hedged lithium prices. You have to take commodity price exposure.
Yeah.
Never mind high price exposure. They won't even take that.
So you won't know what your costs are.
That's all.
Cool. Thanks.
Just a few from me. Thanks, guys. I'll start off with scratch just a little bit more on that long-term sort of price view. Obviously, that's gone up a lot. A couple of questions just to flesh it out a bit. The 100 to 110 you describe as firmed. Does that mean we should expect sort of average spot prices, the simple average, to look the 100 to 110? That's what.
Yes.
And so the second part of that question is that sort of price range then you would expect to be selling long-term contracts to large users? So that's
Yep. Location adjusted.
Adjusted. That's exactly where expected to.
Right. So adjusting for location, the deals you might be signing up, saying the next year will be focused on that kind of.
Yeah.
Okay, that's great. And in terms of the uplift, there's always going to be different technologies at the margin, but are you thinking mainly this is about wind cost? Is that sort of the main driver? Because obviously, geothermal appears to sneak under the.
Geothermal sneaks under. It's wind cost, but it's the cost of firming that wind, which you think of the escalation in thermal costs with coal going to $200, $300, $400 a tonne, gas prices going from what we thought was normal at $6 to $8, sort of $10, $12, $14 a GJ. So it's not just the cost of the actual wind projects, it's the cost of firming, and with the increased carbon price has just gone through. Yeah.
No, that makes sense. Thanks. So what you're saying is the cost has gone up a percentage, whatever that is, 10, 20 maybe.
Yep.
But you're also saying the firming gap. So in other words, the revenue you get out of wind farm is less compared to the 100 to 110 than it was before.
Yeah.
Can you give me a rough ratio of what that would be? So last we talked about 85% GWAP to TWAP.
That's still what we're hearing in the market. Yeah.
Oh, okay, so you've still got that.
Yeah, but so what we've done, so there's sort of a three levels on that. There's also there's capital costs, which are up to 10 to 20%. Then there's your funding costs, your WACC effectively, which are up materially on higher interest rates. And then we've done a wide range of views as to how we're going to get those firming products in the future, transitioning from gas and carbon out to biomass and the like. And, there's numbers out in the market what that means. But once you get to a certain point, every megawatt hour of intermittent you have to add a megawatt hour of firming, green firming. And that's sort of what leads us to our...
Remember firming cost, I think the numbers out in the market, if it's pallets on Huntley or whatever, it's $250, $300 a megawatt hour. So that firming's very expensive. Yeah.
Okay, no, that's really helpful, thanks. And really the second thrust of questions is just around regulatory risk. I mean, you talked about bipartisan support case. So the sort of, potential left field demons somewhere in the tail curve, the ones we could see are maybe around the climate change Commission recommendations, the new ETS settings. They happen to have a section about potential windfall clawback on higher carbon price. There's also the Section 36 changes to the Commerce Act coming through in April next year. I'm just wondered if you have any changes in mind around how you, separate the two parts of the retail versus wholesale. And the third one is the wholesale market review from the EA, and whether you have any kind of flavour for where that's going to come, because we expect something this month.
Yeah, so let's unpack that a little bit and just start maybe at a high level. We should be incredibly grateful in New Zealand that our electricity market is working as well as it is compared to, say, Australia, UK, Europe, where you've seen both external circumstances such as Ukraine war combined with unfortunate political intervention. And, the average consumer in the UK is going to see their energy bill go from £1,200 a year to £4,400 a year. So you're not talking 5-10%, you're talking about a tripling. And you've seen the struggles in the Australian market where a cap introduced on prices, wholesale prices, had some very unintended consequences and potential brownouts. And you've seen energy bills also escalate there significantly, which puts the New Zealand market and its settings and its workings in context. And I think if anyone makes a decision to fiddle and play, there are some some real life lessons about how not to do it. And again, look, the reason we're making that investment today is because we have confidence around a diminished sovereign risk from unfortunate political intervention. And then you go underneath that. Obviously, the wholesale market review, we expect that to be relatively benign, but I think it will send some clear messages around major industrial process players in the market here not expecting a free or easy ride. That is, I think everyone has to pay their fair share in the go forward. I think from a retail price, you've seen the market behave remarkably well and actually protect the consumer from some very volatile swings in the wholesale market compared to what they have actually experienced and compared to what their counterparts in the Western world have experienced over the last 12 months.
Yeah, and I think we showed the graph, Neville, where you can see what retail pricing across the industry is going up. It's like 1% per year. So, and I suspect relative to other industries and the level of price increases that you're seeing around those, the level of increases that you've seen in electricity have been significantly lower. So that obviously helps as well. So yeah.
Super clear, thanks. And just the last kind of follow on that. So we shouldn't expect, when the new legislation for Section 36 comes into force April next year, any change in the way you're currently reporting or currently the way you operate the two?
At this stage, we're not anticipating it, but we're keeping a close eye on it.
Perfect.
And remember, we do have an arm's length arrangement between both businesses in terms of transfer price. So it's aligned to what we, we've got an example of how we're selling to tier 2s at that price as well. So we're about as arm's length as you can get.
That's great. Thank you.
Okay. Thank you. Any further questions in the room?
Maybe just one. Mike, you made a comment earlier around the the green shoots starting to emerge on the demand side.
Mm-hmm.
And I guess we can think about data centres, things like that. Are there any other sort of colour you can give in terms of?
Oh, So 3 years ago, Open Country Dairy did the boiler conversion. We've seen other primary processors get very interested in electricity conversion. Obviously, the Climate Change Commission signalling around the price has given them a strong motivation to come off coal sooner rather than later. And so there's been some good progress in that space in the process heat conversion, high temperature boilers. And we've, in this room, talked about the different data centre opportunities prior to starting this. And it was amazing how everyone went around the room. They could talk to a data centre, those data centres, whether it's Lake Preem, whether it's what Spark have invested in, or you've seen other announcements around the table.
And the domestic hydrogen is looking really interesting. There are a number of industries where very hard to abate carbon emissions, where hydrogen is pretty much the only solution. And so working with those, still at a relatively immature stage, but these could be quite material topics, and they actually need to develop ultimately for New Zealand to hit its climate change targets as well. So some of those are quite exciting.
Great. We've got a question online from from Stephen Hudson. He's got 3 questions. I'll start with one. Stephen Hudson from Macquarie. What non-geothermal development OPEX, if any, in FY23 guidance? The second one is, what have you assumed on AGS availability for FY23 or LDs? What, if any, past due payment stress are you seeing in your retail book? 3 questions: geothermal, non-geothermal OPEX, AGS availability, and any credit concerns.
Okay, so the non-geothermal OPEX, Dorian alluded to that. Obviously, core costs like insurance, we've seen go up. Obviously, there is wage inflation pressure, which is starting to play through. And there is the pre-investment we're making in wind solar pipelines, which turns up as OPEX. We're stepping up the investment pipeline. So that means pre-FID expenditure is going up. So we see those 3 pressures coming through. Second question was AGS. We expect AGS continues to function and function well for us in terms of the amount we can inject and take out each day. We signalled pressure problems at the beginning of the year. There's a technical review group working on that, a joint technical review group with First Gas, and we fully expect the findings of that to come out later in the year and then a solution.
We'd expect the availability to be as much the same as we've seen for FY22. We're not expecting any change, but as Mike says, there's a technical working group that's going to come back with potential solutions to resolve some of the problems that we've seen. And the last one was, I'll take the last one about any issues around receivable collections linked to the environment. So yeah, we have seen a little bit of a tick up actually. I mean, nothing particularly significant, but and when I'm talking to people within other industries and sectors, they're saying they're seeing a similar story. What I would say though is the team at Contact that deals with that is very, very good, and we're able to manage that very, very well during the COVID process, which is obviously the last sort of time that we had a sort of stress on that part of our operations. So very confident in them.
Great. There's no further questions online. So draw that turn in. Thank you very much. Thanks for joining us.
Thank you. Thank you.
Thank you.
Awesome.
So any progress on